2024 has been an unusual year. We've had various ups and downs, unusual Fed policy, unusual presidential election. But one thing that has become pretty normal is the fact that stocks like Nvidia, Costco, and Meta platforms keep going higher. Did you know that since the start of 2023, the S&P 500 has climbed more than 50%? That's pretty impressive, but not when you compare it to the likes of these three stocks. Over that same period, Costco has seen their prices climb over 100%, nearly doubling that of the S&P 500. Meta has seen their stock price climb 380%, and Nvidia, the most impressive of the bunch, is up a staggering 900%. Those are huge moves in stocks in such a short period of time. And with that, we cannot look back as investors, because when we invest our money today, it's more about what you're going to do for me, about the future of the company. So what we're going to do in today's video is we're going to look at these three stocks. I'm letting you know which three stocks we're looking at already up front: Nvidia, Costco, and Meta platforms. And we're going to determine, even after these massive moves, are these three stocks still a buy at today's prices? So do me a huge favor, show your appreciation by clicking that like button down below, subscribe to the channel, and let's jump into it. Hey everyone, Mark Roussin here, back for another video. As always, I'm a CPA and not a financial advisor, so please do not take this as financial advice. And before we begin, let me thank today's video sponsor, which is Dividend Wealth. Dividend Wealth is a fantastic platform. If you have not yet checked it out and you love investing in dividend stocks, this is a platform you don't want to miss. Dividend Wealth is a great platform that not only will help you find new ideas, but also help you research current investments. There's nothing worse than seeing a dividend get cut and stocks fall. So you want to be prepared, and Dividend Wealth can help you with that. As you can see, the platform has a great screener tool, as well as various data points for each individual stocks. And one of my favorite parts is the dividend grades. Right now, for viewers of my channel, Dividend Wealth is not only bringing down the price, but also giving a 25% discount on top of that for a limited time. We're talking about just $5.99 per month to try out the platform, or $60 for an annual subscription. Just make sure you use the checkout code Roussin when signing out. Check out the link down in the description below and give Dividend Wealth a try today. All right, let's jump back into our video, taking a look at three high-flying stocks to determine, are they still buys at today's prices? And let's begin with Nvidia, stock ticker NVDA. Nvidia for the past few years has largely become what I like to call the golden child of the stock market. It seemingly seems like it only continues to climb each and every month, and the stock has soared. Shares of Nvidia are currently trading around $140 per share, up nearly 200% over the past 12 months. And when you zoom out even further, over a 5-year period, shares of Nvidia have climbed nearly 2,700%. A stock that is up 2x in a short period of time is one you might question. I can't invest in that. It's trading at a 52-week high. I'm never scared to invest in a stock that's trading at a 52-week high, just like I'm not rushing to invest in a stock that's trading at a 52-week low. Regardless of where the stock price is, I'm going to let valuation determine whether I'm buying or selling. Valuation has to make sense. Let me show you what I mean. First, let's take a look at revenues, which have exploded the past few years. In 2023, revenues grew 126%, and in 2024, revenues just grew 122% in the latest quarter. When we turn to estimates looking ahead, we are talking about a company that continues to grow at a strong clip. 45% top-line growth is expected next year, with nearly 20% growth the following year. Still, plenty of top-line growth left in the tank for Nvidia. Taking a look now from an earnings perspective, where EPS grew nearly 300% in the last year, and they are expected to end this year with roughly 120% year-over-year growth. Looking ahead, analysts are expecting earnings to grow at a clip of 45% over the next 12 months, followed by roughly 22% the following year. The comps have become very tough, but this stock continues to push out impressive growth. In terms of efficiency, this is a company that continues to expand its margins, meaning they are becoming more and more efficient while also growing the top line at the same time. Operating margins stand at 62%, which is an all-time high for the company, and EBITDA margins are sitting at 65%, another all-time high. Efficient and growing. Now taking a look at valuation. Over the past 5 years, investors have paid an average of 51 times for shares of Nvidia. Today, shares are trading at a forward estimate of 34.5 times, which is pretty reasonable considering the average annual EPS growth rate sits right around 33%, meaning this stock is also trading with a PEG ratio of 1.1, which is very reasonable. Looking at that share price growth over the past few years, and especially over the past 5 years, you would think there's no way that this stock is still cheap. And for a while, I've been saying it on many videos that the stock is actually cheaper today than it was a year ago. And that's because even though the stock price is climbing, the earnings is growing that much faster. So if you had zero position in Nvidia right now, looking at today's valuation, I would say it looks pretty reasonable. And when it comes to me rating this stock, I rate shares of Nvidia as a moderate buy. And that leads us to the second stock we're going to take a look at today, which is Costco Wholesale, stock ticker COST. Costco is the perfect example of a fantastic company with a stock price that I don't like all that much. And part of that hate is due to the fact that I clearly missed the boat. But the second part is valuation is just extreme. Who is paying for Costco at these current valuations? Shares of Costco are currently trading over $900 per share. They are up more than 50% over the past 12 months, including being up 200% the past 5 years. The gains do not necessarily concern me, but the valuations do. Again, this is a great company that's operating quite well, but the valuations are extreme. And at some point, valuations have to make sense. Who is paying for a stock at these valuations with that little amount of growth? Let me show you what I mean. First, let's take a look at revenues. In 2023, revenues grew 6.7%, and over their past fiscal year of 2024, revenues grew 5%. When we look at forward estimates, we're talking about a company where analysts believe they're going to grow top-line revenues 7.5% the next 12 months, followed by roughly 6.5% the following 12 months. That is not growth that knocks your socks off. From an earnings perspective, EPS grew 8% in 2023 and 17% in FY 2024. Looking ahead, analysts are looking for earnings to grow at a rate of 7% the next 12 months and 10% the following 12 months. So single-digit top-line growth and barely double-digit bottom-line growth? In terms of efficiency, this is a very low-margin business, operating with operating margins at 3.65% and EBITDA margins sitting below 5%. Not a lot of wiggle room, with most of the margin coming from membership revenues. So how much could we possibly be paying from a valuation perspective for a stock that's growing in single digits? Let's take a look. Over the past 5 years, investors have paid an average of 39 times for shares of Costco. So it has already traded at a premium even with its lower growth. And that's okay. There are some stocks that trade at higher premiums even though they lack some growth. Over the past decade, that earnings multiple has been closer to 37 times. Today, shares are trading at a forward estimate of 51 times. That is an insane price to pay for a stock growing as slow as Costco. To show you just how out of touch with reality this valuation is for Costco, they're trading at 51 times is far above that of what we just looked at with a company called Nvidia. And Nvidia is crushing Costco in terms of top line and bottom line growth. Not to mention their efficiency is off the chart. So when it comes to Costco, this is an easy answer for me. There's no way I'd be buying shares right here. And in fact, if I owned shares, this would be the perfect spot for me to start taking some profits. So I currently rate shares of Costco a sell. And that leads us to stock number 3, which is going to be Meta Platforms, stock ticker META. If Nvidia has been one of the top performing stocks over the past few years, the one right behind it has been Meta Platforms. And a lot of credit has to go to Mark Zuckerberg on turning around the company and boosting its efficiency. Shares of Meta are currently trading over $550 per share, up 66% over the past 12 months, and up 185% the past 5 years. For years there, Zuckerberg and company were going through a huge spending spree, and there wasn't a lot to show for it. But then analysts and investors got fed up. And what did we see? We saw them launch the year of efficiency, and Meta Platforms has turned around for the better. It doesn't mean that they're still not spending, because they are spending still over $30 billion on capital expenditures. And they're doing it while becoming more efficient. We're starting to see the results as investors. Let's first begin by taking a look at the top line revenue growth for the past few years. Last year, revenues grew 15.5%. And in the latest quarter, revenues were growing at a pace of 19%, largely where they're expected to end the year. When we turn to estimates and looking ahead, analysts are looking for revenue growth of 15% next year, followed by 13% top-line growth the following year. From an earnings perspective, EPS grew 73% in 2023 and 17% so far in 2024. Looking ahead, analysts are looking for earnings to grow at a rate of 12% in the next 12 months, followed by 13% the following 12 months, so still growing at a healthy pace. Now for efficiency. Margins are looking quite healthy, with an operating margin at 40% for Meta and an EBITDA margin sitting at 50%. Now moving to valuation, where over the past 5 years, investors have paid an average of 25 times earnings for shares of Meta. Today, shares are trading at a forward estimate of 21.8 times. So as we could see there, shares are trading at a discount, not only to the company's 5-year historical average, but also their 10-year historical average. But the growth rate has also slowed, so it makes sense for us to see shares trading at a discount. And I believe, based on these growth rates that we are seeing, that Meta is going to trade in that low 20 times multiple, which is where it's sitting at right now. So if you were to ask me to rate shares of Meta, love the company, love what they're doing from an efficiency standpoint. I still believe there's a long runway of growth. I just believe shares at today's levels look more fairly valued. So I would rate shares of Meta as a hold. So there we just looked at 3 of the most popular stocks over the past few years: Nvidia, Costco, and Meta. All fantastic companies, but valuation has to make sense. Nvidia, I still like their valuation. Costco, I hate it, but love the company. And Meta, I do want to see a bit of a pullback before I jump back into a position there. So let me know, how would you rate these stocks? Let me know down in the comments section. If you haven't done so, make sure you smash that like button down below. Subscribe to the channel, and we'll see you in the next one. Take care.